right, lecture 405, moving into digital currencies. So let's begin.
Okay.
Apologies. When we talk about digital currencies, the first thing that everyone asks is a very basic question. Is this a new form of money? Now, it seems like a pretty simple, intuitive question, but like many things in payments, money is a lot more than you imagine at first, because money is something we use all the time, but we never really pause to consider what it does. It's like air. Nobody really thinks what air is, right? It's just part of our existence. So if we break it down, money is three things. It's a unit of account, which helps you denominate the price of goods and services and express value. The way I explain it is, think about when you travel abroad to another country and you want to buy something that costs, I don't know, 58 euros. And it's not intuitive to you. What does that mean? So immediately you take out your calculator or you calculate in your head, what's the exchange rate? What is this price in shekels? Because that's the unit of account that I know. I live with it. That's how I count. That's how I earn my money, and that's how I spend my money. Or if you live in a dollar-denominated country, then you do the same conversion. So it's that number one is very simple and intuitive to all of us, but it has a different meaning in every economy. And so if that unit is fairly stable, then I know how to manage my finances. I know how to manage my family's finances. Businesses know how to manage their finances, both income and expenses. That's the first thing money does. The second thing money does, again, is intuitive, but let's think about it for a second, is a medium of exchange. It enables financial transactions that exchange value between parties. So I can sell something to someone else and they pay me for it. And that's how we exchange goods and services, or at least goods for value or services for value, and the other way around. And so without it, we could engage in bartering like humanity used to, but there's a lot more friction and a lot more questions about what things are worth. And the third thing that money does very clearly is a store of value. So I might be saving up money for some kind of vacation or for a purchase that I want to make. And I slowly accumulate my wealth. It maintains the purchasing power of my earnings, and that continues over time. And that also assumes price stability, because if there are huge fluctuations, then my savings don't mean much. They might disappear because they drop 99% of value, or maybe they'll be worth a lot more, but I can't really rely on them and it's very difficult to predict. And as we think about cryptocurrencies, let's bear in mind, because this is a course about PayTech, there's lots of things about cryptocurrencies that we could discuss, the ideology behind them, the motivation to displace commercial banks and central banks, lots of questions, whether they're a good investment, the technology behind them, and I'll touch on all those things. But when we look at it from a payments perspective, let's always think about whether it can function as a unit of account, a medium of exchange, and a store or a store of value. And when I say it, let's also think about what it is, because the word cryptocurrency or digital currencies has multiple meanings. So to break it down a little bit, we're going to go through how it all began. We'll talk about Bitcoin and Libra. Then we're going to talk about the underlying technology, which is blockchain. Also known generally as distributed ledger technology. Those two don't mean exactly the same thing, but I will use them interchangeably. Then I decided to group them into one category. We'll talk about programmatic cryptocurrencies and stablecoins, what they are and how they can be, what they are and how they function, what their ecosystem looks like. Then we'll go into the specific use cases for what people are doing with crypto and stablecoins. We'll have some time for CBDC, central bank digital currencies, which are a huge topic worldwide, and then I'll make a few observations to close. So how did it all begin with Bitcoin? Well, in 2008, we had a global financial crisis. We're all old enough to remember that. And as a result of that, trust in the financial system began to plummet, which created a reputational impact on governments, on central banks, on commercial banks. Everyone started asking themselves, can we trust this financial system? Do the regulators know what they're doing? Is it still relevant to expect central banks to maintain price stability? What went wrong? And maybe there should be an alternative. So right around that time, the end of 2008, a person or group of persons or entity named Satoshi Nakamoto, who we don't know who that person or entity is, they continue to remain anonymous to this day, published a 9-page paper. And this paper has come to be known as a white paper, and many other white papers of similar nature have been published since. But this was quite an event. It was a very humble way of wording things. And that paper said, amongst other things, I've been working on a new electronic cash system that's fully peer-to-peer with no trusted third party. And that trusted third party up until that day was always assumed to be what keeps money stable and the financial system stable. That third party could be a central bank, or is a central bank all around the world. And yet what he said was, remember the background, we're in the middle of at the beginning of a huge financial meltdown. You know what, maybe we don't need to trust these regulators and banks who are regulated by regulators anymore. Let's come up with a technology that does all the things that we need money to do. And we'll make it fully peer-to-peer, complete democracy. So what else did that white paper say? It said that in order to use Bitcoin, you need cryptographic proof of ownership. And whenever there is a transaction, a purchase or sale of Bitcoin, then instead of letting one centralized entity keep track of all the transactions to make sure that people really own the money they say they own on a centralized ledger by a commercial bank, instead of that, let's use public consensus. Let's make sure that the public at large, and we'll talk about what that means, knows that the transaction took place, and it will be registered on multiple computers. And because it's registered on so many computers, you can't change one and cheat, because you would need to change all of them at the same time. The paper also said that there will be a limit on the number of Bitcoins issued. It's called a hard cap, 21 million Bitcoins. And created this entity called miners, who are validators of transactions, and they can create new blocks on the blockchain. So it's like a chain of blocks connected to each other, which create Bitcoins. And to create a new block, you need a miner that validates a transaction on tens of thousands of nodes. The nodes are these computers that I mentioned, they're like servers. So you have tens of thousands of servers around the world. When a miner creates a new block, so new Bitcoins, that has to be recorded on tens of thousands of nodes around the world. And they have now validated that the transaction took place. And in order to create a new block, the miner needs to do a calculation, which becomes more difficult over time because there are more and more volumes. And in exchange for that, the miner can charge transaction fees that are called gas fees. And the more network congestion there is, the more transactions, the higher the fees. We'll talk about that later, about why that is a little counterintuitive when we think about a free and open economy, that as volumes increase, prices go up. So that's interesting. And the way this all works, I'm not sure that Satoshi Nakamoto understood this or thought about it, but as volumes increase at scale, at global scale, it creates extreme energy consumption because tens of thousands of computers need to record every single transaction, and that uses a lot of energy and is bad for our environment. So that's Bitcoin. That triggered a whole new way of thinking about the financial system, about money, about financial transactions. And another thing that happened years later is that a tiny little American company called Facebook, at the time they were called Facebook, now they're called Meta or Meta Platforms, announced the launch of Libra, which was what is now known as a stable coin, but let's call it a digital currency. And when that happened, I'll tell you, I was working at a company, which was a high-tech company in the mobility space, setting up payments for them. And I remember we had a product meeting talking about the user interface. And I just stopped everyone and I said, all our careers are about to change. My life is about to change because Facebook is launching this thing called Libra, and money and payments as we know it are about to go through an extreme revolution. And I explained it to them and people were shocked. Like, oh my God, this is so extreme that it will impact everything we do. So that was in 2019, but work on Libra began a little bit earlier in 2017. June 2019, there was a formal announcement by David Marcus, who was the head of Libra. Interesting to note that David Marcus before that was the head of Facebook Messenger, which is one of the most important products at Facebook. And the initial plan was to launch a token, a digital currency, digital coin, backed by a basket of currencies and US Treasury securities. So they weren't creating a programmatic cryptocurrency that is not pegged to any kind of other asset. They said, no, we're going to make sure that it's backed by a basket of hard currencies. And soon thereafter, there was a regulatory onslaught. But before I get there, I'll say, Facebook quickly changed the model and said, okay, instead of doing one global coin backed by a basket of currencies, we're going to do a series of individual coins, and each one of them will be pegged to an individual fiat. I think the plan became to do 4 currencies, one US dollar backed, one euro backed, one I think it was pounds backed, and one, I don't remember if it was a yen, maybe there were 3, and then the 4th one was a combination of currencies, kind of like for the rest of the countries. I will say anecdotally that I know about specific countries at Facebook also engaged in direct discussions with regulators and said, you know what, I'll do it in your country's currency. So they were testing the model in various ways. Most of us, if not all of us on the call, are based in Israel. So I will also say that some of the technology was also developed here in Tel Aviv. What's interesting though, is that this was not designed to be decentralized. In fact, it was going to be centralized by Facebook, now known as Meta. And the processing of Libra was by an association at the time called, members of an association at the time called the Libra Association. Later, the Libra coin was renamed to be Diem, and the name of the association became the Diem Association, which was an association of large corporate entities. At the time it was launched, the announcement included Visa and MasterCard as members. Because of regulatory pressure, they ended up withdrawing their membership. So they are no longer, they were not members for very long. In fact, it wasn't clear if they ever actually signed the documentation. But the idea was that these huge global corporations, and some of them were smaller corporations, and some of them were even NGOs, so not-for-profit organizations designed to help promote financial inclusion. All of these organizations and corporations were kind of like the governing board. But what was perhaps less known at the time was that not only are they the governing board, but they're also going to be the only entities that can actually process transactions on the platform. And so it was what we call a permissioned blockchain. So only entities that had permission to work on this platform were going to be able to do so. So it's very different from Bitcoin. It's not like anyone who wants to become a miner can, so long as they meet the technology requirements. It was limited to members of the association. So in a way, it kind of felt like a central bank. If this was going to be a group of 27 companies or 27 entities that govern this new global coin on all Facebook accounts, does that compete with fiat currencies controlled by central banks in individual countries? They also announced a wallet, which they called Calibra and then renamed as Novi. And that wallet was designed to be able to house the Libra name known as DM coin, as well as other cryptocurrencies. And it was supposed to integrate with Facebook and WhatsApp. Now, I can tell you, when I heard WhatsApp, made me think. I don't know about you guys, but I live in Israel and I use WhatsApp probably hundreds of times a day. Now, what if WhatsApp aggressively marketed a coin called DM or Libra to me and to every person living in Israel? I mean, literally overnight, they could probably gain significant numbers of consumers wanting to use this new coin. So you can imagine what this was doing to central banks. I was not a central banker at the time, but it was clear to all of us that this would trigger regulatory opposition, which it did, both in the EU and the US and across the world. Very shortly after the announcement, the Senate Finance Committee, I think it was in the United States, set up a hearing. There were, I think, 2 full days of hearings in the Senate and in the House of Representatives, which were available online. I can tell you, being a PayTech nerd, I watched it all because it was absolutely striking. And if you're really bored and you're really interested in payments, look it up and listen to some of these hearings. It was amazing. It was both Democrats and Republicans giving expression to their political ideologies as they pertain to PayTech. And you know, there are liberal approaches which say, let the technology companies develop and emerge and evolve, and let us be a competitive economy, say American politicians. And then there are others that say, what are you talking about? We are the sovereign power. We need to ensure stability of our financial system, and this could bring us all down. The regulatory opposition evolved and became so strong that eventually Facebook, now known as Meta, announced that they are terminating the project and sold the technology to a group called Silvergate Capital. They actually also own a bank called Silvergate Bank, which bought the technology for $182 million. And as I think many of you know, the names changed from Libra to DM, and then Facebook changed to Meta. So these 2 things, Bitcoin and Libra, triggered lots of thinking and activity, both technology-wise and from the regulatory perspective, and also at central banks, because everyone around the world understood that something very fundamental to money and to transactions is changing or might change, and we really need to understand it. So I think many commentators have written, and I tend to agree, I think everyone agrees, that the novelty of Bitcoin lies in the underlying technology, known as blockchain or distributed ledger technology. So let's talk about a little bit about what that means. What is DLT? So 3 things. Traditionally, when we talk about making a payment, we connect it to a payment method or a means of payment. So that payment might be a card, paid by card, or paid by check, or paid by account. But if you dig deeper, what does the card, the check, the account do? It identifies me as the payer. It ensures that I am who I say I am. and that I am entitled and that to make a payment from funds that I own. So it doesn't matter if it's a card. It could be an algorithm, so long as it identifies who I am. And then I want to make a payment to the payee, to the beneficiary. And I need to make sure that the payee is who she says she is, or who I think she is. I want to make sure that I am moving money to a payee that is the one whom I intend to move money to. And how do I do that? Well, I could identify her with a card, an account, or some other traditional means, but I could also try to identify her by an algorithm. So what Bitcoin is saying is, or the blockchain, sorry, is saying, I can enable identification of a payee or a payer through an algorithm. And I don't need one of these traditional methods that are centralized. I'll do it in a decentralized manner. The second thing it does is it says, in order to identify the payer and the payee and to enable the transaction to take place, I will use a cryptographic hash. I'm not going to go into what that means because I don't fully understand it. But what's clear is that it's encrypted. And there are multiple ways for that encryption to take place. You generally need to be pretty smart to understand it or to write a different type of cryptographic hash than the ones that already exist. And the last element, if we just think about 3 pillars, is that the entire platform is decentralized and works in the way that I explained before, that the creation of every single new coin, incremental coin, and the registration of every transaction which moves ownership from one owner to another owner is registered across multiple nodes, tens of thousands of them, which consumes a lot of energy. They validate, they're also known as validators, every transaction. This concept can have 2 main flavors, permissioned or private, and the other flavor is permissionless or public. Let's start with permissionless, which means anyone who can do the tech can join, like in Bitcoin. Or permissioned, which means you can only join if you have permission to act in this system. Call it a payment system, call it a technology platform. So we saw Libra as an example of only members of the Libra Association at the time, what it was known, were able to process the transactions. And permissionless, perhaps Bitcoin is the best example. If we think about central banks and commercial banks, and we imagine a scenario, a very theoretical scenario, where the entire legacy system, all the technology on which they operate, migrates to a blockchain, then that would also be a permissioned private DLT, distributed ledger technology, because an entity would need a license and would need to be regulated, it would need to be compliant in order to act in that financial system. So very different from being permissionless, where you just kind of need to comply with the tech requirements and you join. So what can you do with this? Lots of stuff, really anything that requires multi-party cooperation or data exchange. So transactions and digital assets we'll talk more about. Non-digital asset registration, like real estate. If you want to register land, normally lots of regulatory and non-regulatory entities that touch the registration process, or even a vehicle. If you want to buy a vehicle, somewhere it has to be registered. Right now, worldwide, it's a central registry, but it can also be on a blockchain platform. Supply chain tracking and vendor management, products moving across the world. How can a commercial entity keep track of that, of all the little elements there? You can do that on the blockchain. Trade finance, identity management, we discussed. And then large value payments, payment systems, securities settlement, and cross-border systems. Those last 3 are actually real projects that have been launched by governments across the world. And here you see a list, which was updated a few weeks ago, so hopefully it's still updated, but you can see literally projects across Europe, North America, Africa, the Far East, South America, and each of these is a world of its own. So there are now multiple blockchain platforms that are available for people to develop offerings. I wrote here partial sample list only. This slide is not a recommendation because I had a situation where I mentioned a particular one of these, and the next day an entrepreneur called me and said that he was going to pivot and change the direction of his startup because he understood from my comment that the particular platform that I mentioned was the one that was going to win. So no, I'm not expressing an opinion. I frankly don't know enough, and I don't think anyone really knows which of these is going to win. I wouldn't say they are competing technologies because they are all using blockchain, but they are different implementations of blockchain in different ways. And when a developer wants to develop a new cryptocurrency or some other offering on the blockchain, that developer needs to make a choice. What should I use? And here on the right, I mentioned a few things. Is it centralized or decentralized? Because you could have a centralized blockchain. For example, you could have a central bank managing its RTGS platform where all systems connect there to ultimately settle funds, and it could be on blockchain. So there are things that are there are blockchain models that are centralized, many of them. And whether it's centralized or decentralized will impact data integrity and redundancy. Question, what is the consensus mechanism? These are the algorithms that verify new blocks on the chain. And the consensus mechanism will impact performance, how much energy you use, how long it takes, how many changes need to take place in the registration and in the code, and will also impact compatibility with other blockchain platforms. What does it cost? Many of these have freemium models. They're supposedly free, but when you start gaining a scale, it starts costing. You get hit with fees. What are the development tools that are available, and how mature is the platform? So as Bitcoin evolved, the theory enunciated in the white paper began to have shortcomings, and the crypto space began to understand that, first of all, it's unstable, very volatile value. We all know that. It goes up and down. Right now, I think we're in what's being described as a winter in cryptocurrencies because the valuations are low, but that's not just crypto. And yet, it doesn't matter, you know, what year or month it is, everyone knows that it's volatile. It goes up and down. So difficult to think about it as a means of payment. It's not scalable because if every transaction needs to be recorded on tens of thousands of nodes, very difficult to do that if you're doing, I don't know, let's say 1 million transactions per second. It's not fully anonymous, which is interesting. One of the value offerings with Bitcoin was no one needs to know who I am. I can be anonymous and I can transact. And people were using that for illicit, illegal activity. And they were also saying ideologically, I don't want to be followed. I don't want to be tracked by Big Brother. But what happened was there were a few hacks, one famous one in Florida by a 17-year-old, where funds were obtained by identity fraud on the blockchain, and where government agents, investigators were able to identify the hackers. And that's for two reasons. One reason is that the blockchain is actually quite transparent. It records every transaction ever made. It might not record who initiated the transaction or who benefited the transaction, but it does record every transaction along the chain, which is actually a lot more transparent than what we have, for example, in correspondent banking. The second thing is that in the real world, at the end of the day, if you want to benefit from a financial transaction, you need to identify yourself. The goods need to be sent somewhere to an address. The money needs to be transferred to an identifiable account so you can withdraw it and use it. And so those two things brought to light the fact that this theory is nice, but in the real world, it's not as anonymous as the white paper would have us think. And then the last thing is that the energy consumption is so extreme that it could, that, you know, if it grows to the point of becoming a means of payment, then it could very significantly impact our environment, which is already significantly challenged. So these four shortcomings triggered new thinking about, okay, how can we solve this? And what became clear was there will not be, okay, I'm going to state a conclusion. It's my conclusion, but I think it's fairly broadly held that there will not be one technology or one cryptocurrency algorithm that solves all of these. It will bring stability, will be scalable, will ensure full anonymity, and will not use a lot of energy. And so different ways of solving parts of these problems started to emerge. And that gave birth to new programmatic cryptocurrencies as well as stablecoins. So just a quick pause here. When we say digital currencies, there are three things that we could mean. In very broad strokes, we have programmatic cryptocurrencies, the best known of which is Bitcoin. These are currencies that rely on algorithms and are not pegged to other assets. Then we have stable coins, which purport to be stable in value. They're not necessarily stable, but they claim to be stable. And they are pegged to other assets, which could be fiat currencies like US dollars or euros or shekels, or could be pegged to other types of assets, which are not necessarily stable. Sometimes they're pegged to programmatic cryptocurrencies, so they can't be stable, but they're called stable coins. So it could be a misnomer depending on the case. And the third category is CBDCs, central bank digital currencies. So when we say digital currencies, it could be any of these. And in the next number of slides in this section, I'm going to focus on programmatic cryptocurrencies and stablecoins. So if we look at them as a group, we look on a website called coinmarketcap.com, which you should feel free to look at anytime. It is publicly available. It tracks the value of cryptocurrencies worldwide, including all three. So crypto assets and stablecoins and what they're calling tokens. And you can see here the volatility. You can see that in January of 2017, these were worth almost zero. And that in January, or let's say mid last year, they reached a peak of being worth almost $3 trillion. And, you know, part of this winter that everyone's talking about, it's getting cold on all securities markets, as well as in crypto. The value of all the cryptocurrencies has now plummeted and dropped to just under $1 trillion. So to understand,
for questions during the presentation or at the end?
I don't think we're going to have time for questions. I have a lot of material. So if you want, you can write me. Sorry. Hopefully, I'll be able to get through it quickly enough for questions at the end. And if you want, maybe I'll stay on past the time that we allotted. In order to understand this, I did quick math a couple days ago, and I looked up the value of gold worldwide, and I only saw 2017 estimates. So I did some adjustments based on current prices of gold. And so I'm estimating, you'll see at the bottom of the slide, that the total value of gold worldwide is about 10 trillion. So it's interesting. Value of crypto is now 10% of the value of gold. And in the past, gold was our standard for, it was our standard unit of measure. So these numbers are quite significant. Are they real? Will they become fiat currencies? Is a good question, but just to give you an idea of what we're talking about, it's beginning to become quite significant. So I'm attempting on all these lectures to give you real names of entities, companies, products. So they'll be at the tip of your tongue should you want to talk about them or read about them. And what I did was just listed here some of the big ones. And I will say again, this slide is not a recommendation to purchase or sell or act in any or transact in any of these. Please assess your own risk and do your own research. So having said that disclaimer, Bitcoin continues to be the leader. Ether, interestingly, is a close runner-up. I mean, it's not close, but it is $134 billion. And then we start dropping. But you can see all of these have significant value. The Dogecoin is interesting. It was started as a joke, and yet it still has an $8 billion market cap. The stable coins that I mentioned are also quite significant. Tether is the biggest one, US dollar coin, USD coin, Binance USD, and DAI are the bigger ones. There are many, many others. There are literally thousands of programmatic cryptocurrencies. There are also many, maybe hundreds of stable coins, but their values are significantly small. So programmatic cryptocurrencies, as I said, depend on algorithms, but let's talk about, some of their features. They're not backed by a central bank or a government or financial entity, and they're not pegged to another asset. There are approximately 10,000 of these. So Bitcoin is only one, and it's perhaps not as advanced technology-wise. They're generally based on distributed ledger technology. There are some exceptions. And typically they use Ethereum. That's the most popular blockchain. All of these are mainly speculative investments based on thinking not only in central banks, but I think economists, you'll find, you won't find many who regard programmatic cryptocurrencies as a medium of exchange. People buy these in order to make an investment as you would a volatile security. In order to prove that you own it, there's a concept, proof of stake. It used to be proof of work in Bitcoin and Ethereum, but proof of stake is a lower level of energy consumption. Won't go into what that means. In the past, historically, when entrepreneurs or developers launched a new programmatic cryptocurrency, they did something called an ICO, an initial coin offering. It is not a coincidence that it sounds very much like an IPO, an initial public offering, when you list shares for trade on a securities exchange, and much money was raised that way. There was also much fraud that was perpetrated that way, and those were regulated away and have almost come to a halt. And the modern, and all of this is modern, but the updated version of ICOs are DAOs, DAOs, which are distributed autonomous organizations, which basically is another way of launching a coin and enabling owners around the world to buy it and own it, but also, and again, it's another way of crowdfunding, just like ICOs were, but it also gives voting rights to decide what are the rules that apply to the algorithm of that particular cryptocurrency. So the DAOs also immediately create a governance structure. So what are stablecoins? As I mentioned earlier, they are pegged to another asset. They're not necessarily stable. The mechanism for pegging to another asset could either be holding it in reserve. So if I have a coin that I claim is pegged to the US dollar, let's call it an Oded coin. Every Oded coin is worth $1 US. So the way I can make good on that promise to you as an investor is that every time an Oded coin is issued, I take a US dollar fiat currency from the US and deposit it in a bank account, a commercial bank account with 100% reserve. That challenges the business model, but there are a couple stable coins like that. Or I can say, well, it's going to be stable based on an algorithm. That already creates questions. If it's based on an algorithm, how stable is it really? Why would you use an algorithm? Well, it's cheaper. You don't need to keep everything in reserve. And there's also this claim that, distributed ledger technologies are all about making centralization redundant and reducing or eliminating the dependence on central banks or on commercial banks. So we don't need these regulators or these regulated entities. We'll just use an algorithm to keep everything stable. It's a nice ideology. It's very difficult to put into practice. And then there's another good question. Why do you need stablecoins? When I first encountered this term, I was quite stricken. Like, why would anybody do this? Why would I buy a cryptocurrency which is pegged to the US dollar? Why don't I just use dollars, right? So main answer to that question is that when an investor wants to buy crypto, to move money from their bank account to a crypto exchange, and that movement creates friction, often for regulatory reasons, but also for technology reasons. And so rather than dealing with that friction every time I want to buy or sell crypto, what I can do is take my fiat US dollars from my bank account and put them into a stable coin, which is pegged to the dollar. And then from that stable coin, I can buy and sell programmatic cryptocurrencies without ever moving the money back into my bank account. And then another reason is, and that way I have that unit of accounts with lower volatility as a basis, which is that stable coin. And another reason is the liquidity. So sometimes the volume of transactions is so big that you need more liquidity in the platform that you use to buy and sell, and stable coins have more liquidity than the crypto exchanges. That might not be an exact statement, but honestly, I never fully understood the liquidity argument. Everyone seems to agree about it, though. What is a stable coin from a regulatory perspective is a good question. Is it a payment system? Is it a platform or a set of rules that enables entities to move money between them on behalf of their customers? Well, yes, it is. But wait, isn't it a bank? So if the stablecoin is holding money in reserve, but it's not necessarily 100% reserve, it's less than that, and it's telling the investors, oh, don't worry, your money is pegged to whatever, the US dollar on a 1-for-1 ratio, 1-to-1 ratio, but I'm not really keeping it all. Doesn't that sound like a bank? Isn't that a little bit similar to the capital adequacy requirements and liquidity ratios that banking regulators apply to banks? Yes. Will you allow, as a regulator, the stablecoin to have the same percentage capital adequacy that you allow banks? Good question. Isn't it both a payment system and a bank? Is it something else? These are difficult questions, and they also change over time because the models of all these cryptocurrencies and stablecoins are changing. Lots of questions around that. And then a good question about, is this going to compete with fiat money? Because as I said, then my first question was, why don't I just move money from a US dollar bank account to a crypto exchange to buy and sell cryptocurrencies and then move my money back to my bank account? Why do I need this in the middle? It's beginning to feel like another form of fiat money that competes with the central bank. And if it's competing with the central bank, then will that limit the central bank's ability to manage monetary policy and financial stability? Because one of the tools we have is to manage the amount of money in circulation. So now let's look at the transaction chain and how it relates to what I just said. We start with money in the bank. We can do a wire transfer, ACH, SWIFT, using SWIFT, or charge a credit card, a debit card, or a prepaid card in order to withdraw fiat money again, US dollar, euro, shekel, whatever it is, and move it into what's known as a VASP, a value-added service provider. I'll explain what that is in a minute, in order to convert the fiat money to cryptocurrency. And then I want to move it into a market that enables me to make an investment in a particular type of crypto, or maybe make a payment, because there are scenarios that these are used for payment. And it could also enable impermissible activities such as terrorist financing, ransomware, human trafficking, illegal drugs, gambling, lots of fun stuff, which triggers attention from government investigators. But let's assume it's legal. It doesn't matter whether it's legal or not. It's the same transaction flow. So the next thing is, I bought Bitcoin. Now I want to sell it at a profit or at a loss. Doesn't matter. Let's say I want to sell it at a profit and I want to pull my money back. So then I need to convert it back to fiat. So I move it into a VASP, again, a value-added service provider. We'll talk about what that is in a minute. And then from there, I move the money back into my bank account, where I deposit the fiat money, which is the proceeds of sale of the crypto that I just described. That's the transaction flow. If you think about stable coins, remember I said that's supposed to reduce friction, it could become a kind of closed garden. Because if we don't want the movement between the bank and the VASP, where there are regulatory challenges and some operational challenges, the investor can just move the money to a stable coin wallet and buy and sell and transact with crypto or with stable coins without ever going back to the banking system. So what's a VASP? Many of you will know an organization known as the FATF. It's a global organization of about 200 countries now, which is tasked with ensuring compliance with anti-money laundering and counter-terrorist financing requirements. FATF stands for Financial Action Task Force, and they defined what VASPs are. So a VASP is a business that conducts one or more of the following activities or operations on behalf of another person or entity. It can exchange between virtual assets and fiat currencies, as I explained. You can convert dollars to crypto and back. It can exchange between one or more forms of virtual assets, so you can convert Bitcoin to Ether and then Ether to Bitcoin, transfer virtual assets, provide safekeeping or administration of virtual assets, and participate in the provision of financial services relating to an issuer's offer and sale of virtual assets. You could actually even give a loan. And in this context of virtual assets, a transfer means to conduct a transaction on behalf of another person, like banks do, that moves a virtual asset from one virtual asset address, because all of these have virtual addresses, kind of like an internet URL, or account to another. So we'll talk about wallets and see how they fit the description of VASPs. So where do I keep my cryptocurrency? I keep it in a wallet, a virtual wallet, which stores keys for the cryptocurrency transactions. How does it work? So a developer creates a coin, and that coin has an algorithm. I'm starting on the left and moving to the right. That algorithm has certain requirements. The wallet, the virtual wallet, creates a unique number according to the requirements of the algorithm. This is for the user. That number is created for the user. The wallet then creates a private key using the algorithm of the particular coin. This is important, that private key. Then the wallet creates another key, which is known as a public key. The owner of the coin can access the private key, and only the owner can access the private key on the wallet. And when the owner accesses the private key, she can give the wallet an instruction to send cryptocurrency to a recipient, a third party, that public, and when the wallet sends the money to a recipient, either in the same at another wallet or the same wallet or a wallet owned by another owner with the same technology, the recipient receives the public key, which is used to record the cryptocurrency. So the pair, the private public key pair, is known as an address, and that is created in the wallet before you've sent any money to any third party. And it's not known on the blockchain at all. It's in the wallet where you store your cryptocurrency. So think about it as a lock that you put on your leather wallet, and only you know how to open and close that wallet. Or let's say only the wallet knows how to open and close that wallet. But when you send it somewhere else, then they need to be able to use the public key to decrypt what you've sent them. And when this transaction goes on the blockchain, the address is recorded on the blockchain. And every time a private key is created, the user is requested to create a seed phrase. These are 12 to 24 dictionary words that the user has to memorize in order to create his private key. The biggest loss of money in cryptocurrencies is users forgetting their seed phrase, and they don't know how to access their money. It's not because it was stolen from them, it's because they just forgot. They don't know how to access their private keys, and I know people that this happened to them. So the wallet will store the key value pair of the private and public keys, and there are two types of storage. It can be stored in a manner that is connected to the internet. It's known as hot storage, and it's faster and often more convenient. Or it can be stored in a manner that is not connected to the internet, which is considered more secure, but it's also less convenient and typically slower. The cryptocurrency does not store the owner's crypto ownership. So the blockchain where the cryptocurrency lives doesn't know your identity. It's only the wallet that knows your private key and therefore your identity. So these wallets are all VASPs, okay? Now, why is this important? Because the FATF published something known as the travel rule, which requires the VASPs to identify the initiators of the transactions, the owners across the entire transaction value chain. And so when the sender and the recipient are identified, that certainly helps prevent money laundering and terrorist financing. And what FATF requested its 200 member states to do is to legislate laws that implement this travel rule. And that law was legislated in Israel in November, which puts Israel in a good place, makes us crypto ready. And this legislation is slowly making its way across the world. So, I just want to go up here. I went up back to the markets in the middle. These can be crypto exchanges where you buy and sell crypto in the middle between these wallets, between the VASPs. So going back down, crypto exchanges that are well known are listed here on the left for you. Coinbase is actually a publicly listed company enduring or dealing with significant challenges now in the current climate. And on the right, you see a list of wallets. Again, this is not a recommendation. I'm not recommending to deal in crypto at all. I don't deal in crypto. I've bought or sold crypto in my life. And I'm not suggesting that you should, but if we want to understand it, it's good to know the names. And you'll notice that some of the wallet providers and the crypto exchanges are the same company. So we all read about this crazy catastrophe called Terra USD or Terra Luna, which happened in May. I thought I'd just quickly take you through what that was to try to get our hands around it, okay, as a quick case study. 2018, startup called Terraform Labs was founded, I think it was in Korea, by two individuals, Do Kwon and Daniel Shin. And they set up two parts of this Terra ecosystem. One was the Terra USD, which has it's almost like a ticker symbol, UST. And that was a stable coin that held itself out to the world as being pegged to the US dollar, but not with a reserve, rather with an arbitrage algorithm. And the algorithm was run on something else called Luna. What was Luna? Luna was a governance token that told validators, you can process transactions on my platform, my blockchain platform, and accrue rewards in a manner that engages in arbitrage with the Terra US dollar, so that you're always aspiring to close the gap between the real value of the Terra USD and the fiat US dollar. So the algorithm preserved the stability through arbitrageurs trading the Terra USD for the Luna in order to gain or lose from the spread between the two, the UST1 and the US1 dollar. If this sounds crazy to you, it is, and yet it gained significant volumes. Why? Because holders of the UST, of the Terra US dollar, pegged to the US dollar, were told, if you buy the UST, we will pay you 20% interest. How? Through a savings protocol, which they called Anchor. Anchor achieved $15 billion in what's termed as total value locked in the system. And the UST grew and grew to a value of $18 billion, to the point that it became one of the larger stable coins. And they also set up this thing called the Luna Foundation Guard, whose job was a little bit like a central bank, to defend the value of the UST. So in May, Terraform Labs decided that they want to start a new product. And to do that, they withdrew $150 million of Terra UST, $150 million worth of this stable coin. And then around the same time, there was an investor who has been described as, kind of like a hacker. They had malicious intent, withdrew $350 million worth of UST. So suddenly, as investors of holders of UST saw that $500 million disappeared from the platform, which triggered a run on the coin, similar to a run on the bank. Everybody wanted out, started selling, and it all went downhill from there. And the arbitrage didn't work. In fact, it created a downward spiral. This thing called the Luna Foundation Guard added $1.5 billion in liquidity, but as cryptocurrency liquidity wasn't enough, the value collapsed to zero in 1 week. If it sounds like science fiction to you, it sounds like science fiction to me too. Maybe because there isn't enough detail here for us to really understand all these intricacies, but it does feel a little bit like fiction. And yet there are real investors, speculative investors, who made these investments and lost their money. That's the Terra story in a word. It was a stable coin that collapsed and really did focus regulators' attention on the question. I mean, not that we weren't focused on this before, but focused regulators' attention on the question of, are stable coins really stable ever? So I don't think the answer to that is no. Sometimes they can be stable if they use the reserve mechanism. If they take 100% and put it in reserve, and there are at least 2 that I'm aware of that do that and get audited by a big 6 accounting firm, which publishes the results of their audit to confirm that there is 100% reserve. The minute they go into an algorithm rather than a reserve, it begins to raise questions. There's one thing that I forgot to say. You wonder about what is the raison d'etre of a stablecoin, meaning what is their business model? How do they make money? So one way to make money is to keep less than 100% reserve and kind of make money, earn on the speculation, which again I think creates significant risk. But another interesting way is just to charge transaction fees. So if it's a stable coin that keeps 100% of its money in reserve, reserve 1-for-1 on a 1-for-1 ratio, then it has a reason to exist because it enables transacting more freely in crypto. But then you wonder, how do they make money? Well, every time a transaction takes place, they charge a fee. So this is not completely theoretical. There is a business case for it, but the mechanism for reserve and for pegging is very important. So we talked about programmatic cryptocurrencies, we talked about stable coins. Now let's talk about what people do with these things. What are the use cases? So lots of noise recently about this thing called a Metaverse. So what is a Metaverse? For those who don't know, it's a digital platform focused on virtual and augmented reality. You see a very nice gentleman here enjoying an experience on the Metaverse. It's generally built using blockchain technology. It creates 3D reality, which enables users to conduct business and access educational opportunities, visit remote locations, experience entertaining events. And if the user wants to buy or sell digital assets in the Metaverse, then typically they do that using cryptocurrencies. And so it's kind of like, think about Monopoly. I want to buy and sell real estate on Monopoly. How do I do that? Well, I get play money. So that play money is cryptocurrencies in the Metaverse. So that's one use. And then another interesting use now is that some of the Metaverse platforms enable users to own them by buying their Metaverse coins. So they issue their own coins. It's another way of raising money. NFTs. So non-fungible tokens are digital assets that are verifiable on the blockchain, things like artwork, music, assets in video games or digital games, such as unique avatars, digital collectibles. So when this whole thing of NFTs started, it was surprising. Why would someone pay a huge amount of money to buy a digital representation of art? Well, because it was minted and it was unique, and this is something that actually happens. The NFTs are sold on marketplaces. And how is cryptocurrency relevant? Well, you create an account on the NFT marketplace where you want to buy or sell the NFT digital asset, and you use a cryptocurrency to make the purchase or make the sale. As theoretical as this may seem to those of us who don't engage in this activity, it does take place. And there are also questions regarding, there's questions regarding AML on this entire space, but I was personally surprised to learn that there are significant actors laundering money through NFTs with all kinds of interesting scenarios. Custody is an interesting model. So I'm debating whether to share this. I won't reveal the identity, but I know a banker who never bought crypto and never will buy crypto. And then I asked that banker, if your bank offered crypto, would you buy it? And the answer was probably. Why? Well, because they're a bank. They're a traditional financial institution. So what do banks do? Banks hold our money for us, keep it safe. So why don't they hold our crypto assets for us? Well, guess what? They have begun to do that. Both banks and investment houses, traditional financial institutions regard this as a business model. So if you want to buy or sell various cryptocurrencies, you could do it through your bank or through your financial service provider. There are not many of these, but there are major regulated financial institutions that do this. And I don't know the percentage, but it would not surprise me if at this point a majority, so more than 50% of the financial institutions are looking at whether they can provide custody as a service. Because think about it, what's the risk to them? They need to implement know your customer. They want to make sure that you're not laundering funds and they know who you are. But how is that different from allowing you to deposit funds that have nothing to do with crypto? So good question about how different their model would be in keeping funds in custody for their customers as crypto funds versus fiat money. But this custody model is a big one. It is the space where the traditional financial institutions are most comfortable dipping their toe or doing more than that in the cryptocurrency space. And it is not a surprise that the new fintech players, the challenger banks, the neobanks, some of the payment companies have also begun to offer custody services to act as a custodian for users that want to buy and keep cryptocurrencies. Because this is so similar to what these financial institutions are already doing, my expectation is that much of the existing traditional regulation will apply that is already the case in some jurisdictions, things like KYC, consumer protections, and disclosures. Another big use case is payments. So many of the traditional payment card companies are looking at this exploding space and saying, well, how can we get a piece of the pie? Visa and MasterCard have enabled issuers to issue cards that convert cryptocurrencies to fiat money at the point of sale at the time of payment. So imagine a fintech company that gets a license to issue a Visa card, and that fintech owns or operates a wallet or connects to a wallet or to a crypto exchange. And so the user owns $10,000 worth of, make it easy, Bitcoin, and that user gets a credit card from the fintech that manages the wallet or the exchange. And every time the user goes to make a purchase at any point of sale, be it a shopping cart online using e-commerce, be it an in-app purchase using a mobile application, be it a physical point of sale, it doesn't matter. Anywhere you can use a credit card, the merchant, the business that accepts the payment doesn't even know that it's crypto. They just know it's a credit card. But what happens in the background, on the back end, is that the minute the issuer receives a request to approve the transaction, or the instant they receive a request to approve the transaction, that user's account converts the amount of money needed for the transaction into fiat currency, and that's the money that goes into the payment card system. So if I make a $100 purchase, my wallet will immediately sell $100 worth of Bitcoin or whatever it is I have there, convert it to US dollars, and those US dollars will make it through the system ultimately into the business's bank account, the merchant's bank account. And there are over 100 of these at this point. Both Visa and MasterCard have been pursuing this space actively, and they disclose this information in their financial statements. It is one of the ways that they are seeking to keep themselves relevant in the event that crypto continues to grow. And then you've got lots of tech companies in the payment space or in related spaces that enable payment with crypto. PayPal is doing this in the United States. It's being trialed. There's different pilots, different types of cryptocurrencies, but this is something that is in production and is actually happening. They're still testing, but there are users of PayPal in the United States that make purchases using their crypto accounts. Same with Square. And even with Shopify and Wix. So for those who don't know, Shopify and Wix is an Israeli platform, are platforms that enable businesses to build websites and sell products and services. And when the business sets up the website and sets up a shopping cart, they have a plugin that now allows the business to decide that it will accept payment by crypto. And it's really not even difficult to implement. And again, similar scenario. As soon as the payment is made, the crypto is converted to a fiat currency, which ultimately makes it to the merchant. So we're beginning to see very niche. And if you remember my first lecture, I said, is this going to happen? It is happening. We're going to see very niche use cases. These are very, very small volumes. But in my first lecture, I said, and I'll say it again now, do I think this is going to become big? I don't think so, because I think cryptocurrencies are a speculative investment. I don't regard them as a means of exchange. Again, except for very unique cases, for ideological reasons, or for cases where traditional payment methods are not working. It's extremely rare, and it's mostly in the crypto community. But what I said in the first lecture was, it's like a security. So if I own shares of company X, publicly listed company X, Y, and Z, am I going to want a credit card from my brokerage house so that every time I shop at the supermarket and I pay $300, it will sell my shares of company X, Y, or Z, which I bought for speculative reasons or for my pension fund or whatever it is, in order to pay at the supermarket? I don't see that happening. But it is a growing space, and there are more and more examples of issuers doing it. The more popular use case is something that has come to be known as decentralized finance, also known as DeFi. So, oh my God, it's almost 7 o'clock. What is DeFi? DeFi is using cryptocurrencies and stablecoins to engage in traditional transactions. So trading securities, insurance, lending, borrowing, P2P lending, where individuals give loans to each other with crypto. This is actually happening. Something called yield harvesting, where speculative investors lend crypto to borrowers, but it's usually in order to buy or sell cryptocurrencies. And then this new concept that's come on the scene called flash loans, where a user can borrow and repay funds in the same transaction, which tends to be highly speculative. Okay, I am going to go over time a little bit, and I think we're going to have to spill over into the next lecture with the second part of this presentation. Let me just go over a few minutes and talk about Celsius, which was another case that was reported in the media. So what was Celsius? Celsius is a crypto lender. So you can borrow funds in crypto from them. It was founded in 2017. They raised money with an ICO, then they raised more money. They achieved a valuation of $3.25 billion. They enabled users to also receive interest on cryptocurrencies that were deposited with them, or to take out collateralized loans. So you deposit one crypto in order to borrow money and buy another type of crypto. By May of this year, they lent out $8 billion to clients and had $12 billion of digital assets under management. And then in June, this month, suffered severe losses because the markets are tumbling. And on June 12th, they announced that their users who have deposited crypto funds with them can no longer make withdrawals. I went on their website a couple of days ago, and here's a screenshot. It says, our website is currently this has been there for a while. Our website is currently being updated related to the previously stated pause on withdrawals, swap, and transfer between accounts. Some of our products and services are temporarily unavailable. For more information, see our blog. And when you go to the blog, you see we are writing with a very important message to our community. Due to extreme market conditions, today we are announcing that Celsius is pausing all withdrawals, et cetera, and they're doing all they can They're working very hard to deal with this. What was also very interesting was that when I was doing a little research on this on June 25th, which was 2 days ago, Goldman Sachs there was a headline that Goldman Sachs is looking at buying Celsius's assets and they're leading an investor group. They're not going to buy it themselves, and they're looking for $2 billion in commitments. So this is actually viewed as a real live going concern, which is about to go bankrupt, but still has a business model because so many users are depositing cryptocurrencies with them. So I'm going to end here because we just reached the central bank digital currencies part and we are out of time. What I'll do is, for anyone who wants to stay like 5 more minutes, we can do that. And then in my next lecture, I'll complete CBDCs and then do the other 3 topics that I mentioned. I see that I'm being a little bit overambitious with all this information I'm trying to give you guys. Hopefully you found it useful. And if you have any questions, we can spend a few minutes or we can end it here. Someone.
Zvi, you had a question.
Yes, I have a couple of questions and I will be happy to stay a few more minutes if you let me. So first you mentioned like a hypothetical person who has some securities and has a credit card, and each time he's going to buy a cup of coffee, his bank will sell a few shares from his account. And you laughed at this, but actually there are money market funds that allow you to keep money, to earn some interest. And each time you can write a check, you can use these funds. So
yeah, I think money market fund, it's a question of perception. What is a money market fund?
It's a type of security, but
why it? Sorry?
It's also a type of security.
Yeah, okay. And so fine, that will happen. I don't think it will become a popular means of payment. It is a use case.
Okay.
I mean, how many people on this call actually do what you just described? I would say in Israel, probably none.
Not for a cup of coffee, but again, in Israel, it's difficult. There are virtually no kronot kaspiyot till now. Hopefully, when interest rates will go up, they will reappear.
Okay, and in the US?
In the US, of course.
It takes place.
Not for a cup of coffee, but there is a minimal amount, like $200, and then you can write a check from your Vanguard.
Okay, that's different. That's making a withdrawal. That's not using it necessarily for day-to-day transactions.
Okay. But for at least from some level, okay, I agree. No, not for
I take your point. I take your point, and as I said, there are niche use cases where this will live.
Mm-hmm.
Will it become a payment method that everyone uses, like a credit card, like other types of credit cards? It's very theoretical. I don't expect it to happen. I agree with you. There are niche cases, but it's not mass market.
Let us assume a completely hypothetical situation when interest will go from 1 to 3% to 15%. As soon as interest rates are high enough, you'd better not keep too much money in your liquid account. Then the popularity of money market funds will increase.
Fair enough, but who's paying the interest on crypto?
No, wait. I'm not talking about the crypto.
Okay.
I understand. Now, the second question is also a continuation of this, and this will go towards the CBDC. There are various securities, and today there are central counterparties and even QCCPs, qualified central counterparties, that act actually as wallets. They keep our shares, they keep our bonds, and we can identify ourselves. Isn't it very similar just to wallets that can be used for any currency? And as a continuation of this, my question is, why do you put CBDC in the same category as cryptocurrency?
Oh, I don't. They're completely.
Okay. So it's completely.
I just when I say the word digital currencies, I want it to encompass everything that people can intend. So I don't say that CBDCs are cryptocurrencies. I do say that they are a form of digital currency.
Of course.
Please, semantics. It's a completely different world, and we'll talk about that in the next lecture. I agree with you. But there is a connection between them, and that's spoiling my last slide, but I'll share it. And that is that it may be the case that the existence and growth of programmatic cryptocurrencies and stablecoins is what triggered all the discussion about CBDCs. Is that justified? Good question. But I don't think all of this would be happening. All the 90 central banks exploring digital currencies would be happening if we didn't have this threat to the relevance of fiat currencies. And that's why kind of central banks are thinking about, well, maybe we need to modernize and go to CBDCs. But that's the only connection.
And then my last question is, and maybe it's your intent to explain it in the consecutive lecture. My understanding is that central bank digital currency is identical to the following situation. Assume that Central Bank of Israel opens 10 million accounts for each citizen and allows us to transfer funds from my account to my neighbor account immediately and very cheaply. And that's it. Isn't it almost identical to CBDC?
We need to talk about CBDCs before I answer your question, but there are a lot of similarities in what you described. Very quickly, there are two CBDCs. There's 1 tier and 2 tier. 1 tier would enable citizens to open accounts directly with the central bank. 2 tier would enable third parties to distribute the digital coins, which is kind of similar to what we're doing with cash right now. And so I don't think the citizens would be opening accounts with the central bank. Almost all, in fact, I think all the projects we're familiar with are 2 tier. We talk about 1 tier as a concept, but it's not really anything central banks think they can do because central banks don't know how to deal with millions of customers.
Thank you very much.
Thank you all. Do we want to? Does Ava have her hand up with a question, or we're done? Oh no, that's not. That's my my cursor. So never mind. Okay.
Thank you very much.
Thank you for your time. And this was recorded, so we'll put it up on the various digital channels.
Thank you.
Thank you, Oded.
Thank you.
Bye. Pleasure.